Hello, everybody. Good afternoon, and welcome to today's International Policy Talk, which is a collaboration between the IIES and SNS. My name is Krusell, and I'm a professor at the IIES, and I'm very happy about this collaboration. The idea is that we bring in regularly to our department at Stockholm University world-leading researchers to talk about their recent work. And when they have done recent work that is something we think is policy relevant, we contact SNS and this joint venture happens. Let me introduce today's speaker, Professor Silvana Tenreyro. She will talk about economic shocks and trade. Silvana, I'm going to call you by your first name, Swedish style. Hope you forgive that. Silvana got her PhD at Harvard. She has worked in research in macroeconomics, broadly defined, but made very important contributions both methodologically and substantively within especially monetary economics and trade and development. So spanning several parts of macro. The monetary work, I'm sure, was a reason why she, since 2017, was elected to be a member of the Bank of England Monetary Policy Committee, where she's currently also serving. So I'm sure that some of what she will talk about will connect to that. The final thing I should mention is that we just learned a few days ago that Silvana is the recipient of the 2021 Yrjö Jansson Prize, which is a very prestigious award to researchers active in Europe in economics. It's given every 2 years, and it's sort of the European equivalent of the John Bates Clark Medal in North America. She received it together with Ricardo Reis. Both of them are at London School of Economics and Political Science, and both of them are macroeconomists. So with that, let me congratulate you, Silvana, and invite you to start presenting, and then we'll discuss. We have Professor Rikard Forslid here, we have Karin Karlsbro here, and who is a member of the European Parliament representing the Liberal Party in Sweden. And we would very much like all the participants to ask questions if you like, and there's a Q&A area at the bottom of your screen. So please send your questions, but now it's over to you, Silvana.
Thank you very much, Per, for the kind introduction, and thank you very much for having me today. So let me share my screen. Today I will talk about, first about the global outlook, what we should expect for the rest of the year. With vaccines being rolled out now in many countries, we should see a return to growth globally. But with the pandemic still at large in most of the world, inevitably there will be some divergence in growth prospects, possibly leading to further supply chain disruptions. And I would like to link these disruptions to a perennial question on the merits of globalization, which has become very topical these days. There has been a rekindling of an old perennial question or narrative, building on the idea that countries need to be self-reliant in order to build resilience and stability. So put differently, reshoring or concentrating production domestically should, the argument goes, reduce exposure to shocks. And there's a nice article on this in The Economist last week. I will draw on my previous research to argue that the idea of concentrating production domestically can be a very risky strategy if the goal is to reduce volatility. So let me start with the global outlook. At the Bank of England, we will be updating our global forecast as part of our quarterly policy report in the coming weeks. For today, I will show you the latest IMF forecast. Probably the Bank of England forecast will be similar in some ways, different in others, but generally they have shown the same general picture over the pandemic. So this chart shows the April 2021 global GDP growth forecasts for 2021 and 2022 with the update since January 2021 here in orange. So you can see that throughout, the forecast has been for a sharp recovery in 2021 from the large output drop that we saw last year. There have been two changes to the outlook in recent months. First, growth forecasts have been revised up, especially for 2021, as you can see in orange in here. And second, markets, forecasters, and policymakers have become more certain about the likelihood of recovery in global growth this year. At the same time, upward forecast revisions have been larger for advanced economies, shown in the middle here, relative to emerging and developing economies on the right-hand side. You can compare the orange blocks here. So growth rates are, of course, still expected to be higher in emerging and developing economies on average, but by less than we would normally expect, and by less than was anticipated going into the pandemic. In other words, advanced economies look set to escape the economic impact of COVID much more quickly than emerging or developing countries. And even among advanced economies, there's a large degree of heterogeneity, with the US in particular forecast to grow very strongly this year, despite a smaller drop in GDP than many of its peers last year. So in sum, we have a recovery in global growth over 2021 and into 2022, but relative to pre-pandemic trends, this will be stronger in advanced economies, led especially by the US. There are two main reasons for both recent forecast upgrades as well as the divergence across countries. The first reason is policy support, both over the pandemic and in prospect. The chart here shows the IMF's estimates for the change in the fiscal balance each year in advanced economies on the left and in emerging and developing economies on the right. In 2020, fiscal policy was able to respond more in advanced economies, where financing worries are much less acute than in many emerging economies. As well as the scale of fiscal response, the type of response may also have been important. I discussed in a recent speech how the skew of the US fiscal response towards one-off payments, so-called stimulus checks, may have boosted demand by more. Interesting, and this is parenthetically, unlike any other US recession, household incomes in the US increased during this pandemic. Most important for the recent forecast upgrades, fiscal policy will remain loose in 2021. This is especially the case in the US, where the recent stimulus is larger than many of us had expected, certainly last year. And overall, advanced economies deficits are set to continue further in 2021, unlike in emerging and developing economies where fiscal policy will actually start to tighten. The second reason for recent upgrades and for the divergence across countries in the speed of the vaccine rollout is shown here in the slide for some selected countries. Overall, the development of vaccines has led to greater certainty that the effects of the virus will fade over 2021 and beyond. And the relatively fast rollout so far in several advanced economies is another factor likely to help the pace of recovery. But as the chart here shows, in many countries, particularly in developing countries, vaccine rollouts have been much slower, and they're likely to remain so for some time. On top of the direct health implications, this divergent pace of vaccination also creates economic risks. Even countries where vaccination is scheduled to be complete by the second half of the year, like the UK, will be impacted by weaker activity in countries where vaccines are less available, especially emerging markets. With continued high prevalence, these countries are likely to face further difficult decisions over whether to lock down their economies or not. And as we saw in 2020, this also has the potential to disrupt supply chains, impacting on trade and activity worldwide. So this experience of some supply disruptions during the pandemic has brought to the focus, as I said, the old question at the intersection of macro development and international economics. How does globalization affect macroeconomic volatility? And a widely held view in policy discussions seems to be that openness to international trade leads to higher volatility. The view is rooted in the idea that openness to trade increases specialization, and because specialization in production tends to increase a country's exposure to shocks specific to the sectors or range of products in which the country specializes, it is generally inferred that trade increases macro volatility. This view seems present in policy circles where trade openness is often perceived as posing a trade-off between two goals or two possibilities. Trade brings higher aggregate productivity gains, but at the cost of higher volatility. So in my work with Francesco Caselli, Miklos Koren, and Milan Lisicki, we study the link between openness to trade and volatility, both from a theoretical and a quantitative or empirical angle. We highlight two important mechanisms mediating the relation between trade openness and volatility. One, the sectoral specialization channel, the notion that underpins the prevailing policy view. And two, the idea of country-wide diversification. So the idea here is that openness to trade allows countries to resort to a broader set of suppliers or potential buyers, and this reduces exposure to any single trading partner, and hence cushions the impact of shocks to specific partners, leading to lower volatility. And after exploring the two channels theoretically, the paper quantifies the contribution of each of them. So let me say a couple of words about the two mechanisms. First, trade leads to more specialization, increasing exposure to the sectors or range of products in which a country specializes. And implications from this channel are broadly consistent with the standard view. More international trade, by encouraging specialization, can lead to higher volatility. But there's one important caveat here, which comes clearly from working with the models. Whether volatility increases or not depends on what sectors the economy is specializing in. There are some safer sectors, some riskier sectors, and on how shocks to those sectors co-vary between each other and with the country's macroeconomic shocks. So it's conceivable that some specialization patterns in certain sectors that have low intrinsic volatility or low covariance with others lead to lower macroeconomic volatility. And hence in the paper, we question the mechanical assumption that higher sectoral specialization necessarily leads to higher volatility. It really depends on the sectors in which economy specializes. And turning to the second channel, diversification, the idea is that by relying on more suppliers and buyers, trade can help diversify shocks. This, contrary to the conventional view, can lead to lower volatility. A slightly more subtle angle is that trade in other countries' inputs allows an economy to access technologies that can help combat risk. And the vaccine development is one example. Not all countries were successful at developing vaccines, but they can all rely on the technological discovery made by the very few more advanced economies. So in the paper, we quantify these two channels using a general equilibrium model together with data on sector level production and bilateral trade flows for countries that are at different levels of development. And this allows us to quantitatively assess how changes in trading costs have affected GDP volatility over time. And the results of that exercise are shown in this table. We find that the decline in trade costs since the 1970s has caused sizable reductions in GDP volatility in most countries in our sample, while it led to modest increases in volatility in very few. The range of changes in volatility varies significantly across countries, with the largest decline in volatility due to trade in excess of 60%, and the largest increases in volatility due to trade of around 2%. On average, trade reduced volatility by over a third. Sweden, highlighted here in red, saw a reduction of volatility of over 40% due to the fall in trade barriers since the 70s. The general decline in volatility due to trade is the net result of the two mechanisms I described: sectoral specialization and country-wide diversification. The diversification mechanism contributes to lower volatility in most countries in the sample, suggesting that there is indeed scope for diversification through trade. Equally interesting and against conventional wisdom, higher sectoral specialization does not always lead to higher volatility. For nearly half of the countries, including Sweden, the sectoral specialization channel contributed to lower volatility. And as with the overall net effects of trade on volatility, the relative importance of the two channels we highlight here varies across countries. Though overall the effects of specialization or the specialization channel is much smaller than the diversification mechanism. So to summarize, our research challenges a standard view that trade openness increases volatility. It highlights a new mechanism, country diversification, whereby trade can actually lower volatility. It also shows that the standard mechanism of sectoral specialization, usually deemed to increase volatility, can actually lead to lower volatility. And the paper suggests that diversification of country-specific shocks has generally led to lower volatility since the 70s and has been quantitatively more important than the specialization mechanism. So the broader takeaway is that the call for reshoring or deglobalization is a risky strategy. As Don Quixote already observed in 1600s, is not a good idea to put all eggs in one basket, even if it's a domestic basket. And one form of saying this more suited to Sweden's nautical tradition would be, don't trust all goods to one ship. If the goal is resilience and stability, diversifying suppliers and buyers remains a good strategy. Of course, there might be other arguments against globalization. Some have argued that while globalization increases the size of the pie, it has created winners and losers, leading to more inequality within countries. Now, economic theory tells us that international trade can improve everyone's well-being. In the jargon, it can be Pareto improving if there is a system of transfers that can compensate those who lose from international trade, for example, through reskilling workers who lost their jobs. Too often, the if or the conditional clause got lost and countries open to international trade without proper schemes to compensate or reskill those left behind. But deglobalization is not the solution to this problem. It will create new cohorts of losers and winners with a smaller pie. So I will pause here for questions, and thanks everyone for your attention.
All right, thank you very much, Silvana. So again, feel free to write down your questions in the Q&A. I'll soon hand over to Rikard to make some comments, but just kind of quick follow-up on the actual research that you talked about now in the second part of the talk. You're making a point that wasn't obvious to me, which is this point that trade can actually lower volatility, and I think it's very interesting, and it was very interesting to see also how the effect varies across countries. But does your work also update us on like the average effects of trade? I mean, I know there's been, of course, $1 million question about what's the average gains from trade in the world, and I know that at least some economic research, although it suggests that the average gains are positive, they're not huge, and also putting these two together, which one do you think is most important now that we have this new evidence that volatility goes down with trade, so what about the gain from trade, given that you have this new empirical work? It would just be interesting to hear, because there's discussions always about trade wars, and is it bad, is it good, and notwithstanding all the problems, what is the updated view on the average gains we make?
Yes, so it's interesting because when we started from our theoretical models, they made very clear that the average gains from trade would be positive, and hence that was something we all relied on, no questions. Then came a new wave of quantitative papers trying to put numbers on these gains, and in that initial wave, the average gains were indeed positive, but typically very small, and they all came from models with the static models and no frictions, and in general the average gains were relatively limited, particularly for the more advanced economies, which stood very little to gain from the exchange. There's a new wave, and I guess Thomas Sampson, my colleague at the LSE, is one of the people behind it, linking trade to growth. And once you put growth into the equation and bring in those extra boost to growth that trade can bring in, then the gains from trade become much more substantial. So I think that literature is still there, and it has evolved from a belief that the models were right, then to the quantification that initially was a bit disappointing because there was a gain but not much, and then this new wave that linking it to growth brings in a lot of new dynamic gains that make the gain more substantial, confirming what the earlier theoretical economists had in mind. So I think that's less question right now. The first moments, there are gains from trade. On average, there is a benefit for all countries. What is under discussion is whether those average gains are distributed in a way that benefit everyone, and there's obviously a lot of contention, and the idea that trade has created winners and losers has reopened the question on that regard. Is it worth to pay that cost? And again, going back to the theorems of international trade, we know that everyone can benefit as long as there is a system of transfers and taxes that can help compensate the losers. Without that, there will be losers, and obviously that's something to take into account if inequalities is an area of concern or part of the goals of the government. But equally reversing that and going for deglobalization in order to undo the inequality effects of trade, that's what I was trying to say, will not solve the problem because it will generate a new cohort of winners and losers, and without the bigger pie. And that's the challenge that will be much worse, I think, if we reverse that.
Thanks. We are receiving questions now, and some of them are very interesting, and I'm going to raise them, but I think we should, I'll first let Rikard make some comments, and then I'll go back to the questions. Some of the questions have the nature that they comment on the recent COVID experience and how different countries have had different experiences and so on. And I mean, one issue there is that the uneven development will affect trade like this, as you call them, idiosyncratic shocks. Some places do really badly, some do well, and how is this all going to play out? But we'll get back to that after Rikard says what he wants to say. So welcome, Rikard, who is a professor at the Department of Economics at Stockholm University.
Okay, great. So thank you for a very interesting presentation, and I certainly agree with your conclusions. So I think this is very important, very interesting research and very nice. So I basically have some ideas and thoughts, but I really don't disagree very much with anything. But so my first thing was that as a Swede, you know, we're interested in small countries, and in your model, in your research paper, it's very clear that the risk that trade will lead to more volatility is higher for small countries. I'm not sure that came out in your empirical application, but in your theory, that's clear. And the reason, of course, is that you import a big share of your consumption. So if you import volatility, and that may pose a risk. Now, on the other hand, of course, it's the case that small countries have more to gain from trade. So it's interesting. There is like this, risk return ratio. It's like a Sharpe ratio that would vary with the size of the country. So I wonder if you've thought about that. So that seemed to me like a sort of interesting thing to think about. I don't know maybe if they vary linearly and so on, but that's one point. Then I'm a trade economist, not a macro guy. So, and I worked a lot with the, trade models, Dixie-Stiglitz type of trade models, and there, I guess a lot of trade there is intra-industry. So this is where advanced countries like Sweden and Germany exchange cars. And in those type of models, of course, it's not really that trade leads to sectoral specialization, which is what created, in a sense, risks in your analysis. So, but their trade would just lead to more varieties in your consumption basket, and basically pretty much decrease risk of volatility, or in some sense hedge your consumption basket. So I wondered about this, the presumption that trade increases volatility. That may not actually be that presumption. I'm not sure all trade economists had that presumption, but clearly, if you think about sectoral specialization, it's there. And then, of course, trade. A lot of trade theory is about firms. So you're having a little bit more of a macro perspective, but a lot of trade research is on at the firm level, and there the increase in trade. If we forget the last few years of decrease here, then a lot of the increase was driven by global value chains, so the rise of global value chains. And there, this risk-return trade-off is sort of down at the firm level. So firms, in a sense, presumably firms take these supply risks into account and so on, and weigh them a little bit against productivity gains, possible productivity gains. But the difference between the micro and the macro perspective is that at the micro level, whereas the sectoral specialization of a country is more exogenous, it depends on comparative advantage. I guess at the firm level, the specialization at the firm level, where the firm decides what to actually produce at home and what to source, there's a more explicit risk-return trade-off that the firm does. So there's a little difference there that I thought was interesting. Anyway, I think I'll stop there, but thanks for a great talk.
Thank you, Rikard. Per, shall I answer?
Yeah, I think it would be good if you comment, if you have some comments on Rikard.
Very good. So thank you again, Rikard. These are great comments. On smaller countries, I mean, you're right that they're the ones to stand to gain the most in terms of the first moments. The gains from trade are larger from them in terms of those first moment gains. But in terms of volatility, you see how the channel we introduce makes the old idea that by specializing they would be more exposed to volatility, and the idea of this trade-off very clear here. If you look at the specialization channel, it's true that they will be the ones who tend to specialize more by their size. So they will be more exposed to volatility. But looking from the perspective of the diversification channel, they are also the ones who gain the most by diversifying suppliers and buyers. And so what we get at the end from the analysis is that smaller countries benefit more from the fall in volatility. They reduce the loading or exposure to their domestic shocks significantly by trading abroad. So if you are a developing country, very small, actually the gains from lowering the volatility of your GDP basket are the largest by trading. We do have intra and inter-industry trade here. So there are sectoral shocks, there are country-specific shocks, and there are idiosyncratic shocks, which would be sector and country-specific. So the quantification we do is, inferring from the data how these shocks have played out through the years, as it's explained in the paper. And it might be that coming from the perspective of intra-industry trades, then you didn't have the same priors as in Newbery and Stiglitz old paper, where trade did place a trade-off. So I'm glad to see that. I don't have to convince you. And the analysis can be carried out at a more micro level, looking at firms and the global value chains. We do have global value chains in the paper because we linked or a way of modeling through the input-output structure, which again, we try to get from the data. We use that input-output structure there and allow that configuration in the production process. But obviously one could go more at the micro level and carry out the analysis using firms. And my sense that the same intuition will apply, that if you are a firm, you will try to diversify your suppliers so as not to be exposed to any single partner.
So Silvana, may I pick up a little bit on that too? In part because of what you and Rikard just discussed, and in part because of a question from the audience. One general issue that's been a notion in trade economics maybe is that protectionism could be good because it might allow you to, infant industry argument that to develop your industrial structure, it might actually be good to be a bit protectionist. So that question was raised from the audience, but in this context, it's a little bit more of a sophisticated version of that, which might be, is there a choice, an active choice in what sectors and products a country specializes on? And is that something that you think is the market doing a good job there? Or is there a role for government to steer the domestic economy in the direction of, having low volatility as a result, in the direction of diversification? You can see how individual firms and businesses might not take this into account. But if they all flock around the same industry, maybe that's a bad thing. So it's another kind of version of not protectionism, but steering markets in a certain way. Do you think that that's an issue that your research should make us think about?
Yes, so I guess the question is whether we should look into more coordination of where you develop and what sectors. Should there be more guidance, or should be this left to the markets? And my reading of the evidence is that it's very mixed. We know the winners, the cases where the infant industry argument has worked well. but we don't know all the failed attempts, and so that's why it's very hard to to take a strong stance on whether the interventions by governments have helped or not in selecting that sectoral basket. And it's conceivable that that same sort of result applies to the volatility one. Are governments better than markets? Can they foresee where the shocks are and take into account all these shocks? And perhaps some governments are at certain times. Do they have the the tools and the sort of capacity to foresee that enables them with better decision making that the collective from firms is unclear. And so what I showed you here is more of a positive analysis. So what happened as countries decline their trade barriers, or saw a decline in their trade barriers over time, what happened to volatility, but is not a normative analysis, in that we're not saying, okay, the government should intervene here and do something. I mean, it's conceivable that the country decides, and I know, for example, in Argentina, there were many attempts at developing, especially in agriculture, which, the area where I come from, it was very specialized in sugarcane, and there were attempts to diversify the agricultural set of products. Some didn't work out very well, and then it took many years, and it was mostly, driven by demand from abroad, that other sectors in agriculture, like citrus and all that, developed in that area. So so there are, my answer is I really don't know. We normally see the winners from these attempts. We don't see the failed ones, and so I don't know how to weight the two, and whether taking those risks and those failures paid out in the end. I think that seems that agrees with my reading too. But it's an interesting issue that I think your work makes more relevant than I had thought it was before. So I mean, even as you bring up, even within countries, there are these issues: who should specialize in what, and what does trade between regions do? And I guess that is a segue to Karin Karlsbro, who is a politician within a union of countries, the European Union. And Silvana, you have two legs, I noticed, because you're an Italian citizen as well as an Argentinian and also a British citizen. So I don't know if that makes you what? 3 legs.
Yeah, so but I don't know if it makes you an EU person or not, but anyway, Karin, would you like to make some comments?
Yes, thank you so much for the opportunity, and thank you, Professor, for this presentation, and thanks to SNS to arrange such a great event. As Per mentioned, I'm a politician, and I'm a member of the European Parliament, and I'm a member of the Committee of International Trade. So I think most often I see myself rather theoretical. Trade policy is rather theoretical, but today I think I'm more a practical hat, and you are the academics. So maybe I give you a more practical view on this, how we discuss this in the International Trade Committee. And but it was really an excellent start of the week to have this academic view on trade, because we really need more knowledge, more facts, more research for this. And as you know, on the top of the agenda in the European Union is right now vaccine. It's number 1, and it's number 2, and it's number 3. And vaccine nationalism, vaccine protectionism, it's really on the top of the agenda. And I think that highlights how the economy looks like today with global value change and the risks and the advantages. And we also deal with things you are very familiar with, like strategic autonomy or open strategic autonomy, and what does it really mean? Now today we have listened to the economic aspects of trade, but there is a huge political dimension on this. And that makes trade policy so relevant and very interesting. And so my question is, after this presentation, you gave us some take-home message, but I would of course like to know, ask for some more concrete advice. I mean, being resilient to shocks is not only about coping with the blow, but it's also about how fast we can recover from the blow. How do you see the route to recovery after COVID? And what are the mistakes do you fear that political leaders might make now? I think we have to learn a lot from the pandemic, and I hope that we don't go back to normal. I rather hope that we create something better. But in the debate in the parliament, it's very much focused. I mean, now I'm just maybe a little bit dramatic, but for example, we had a discussion on this for some weeks ago. Options for reshoring production back to Europe in a globalized economy. That's an example of the headlines for our debates. But from your perspective, which could you give me your advice? And of course, on a European Union level, because I mean, trade policy it's an EU level on the EU level. So. We have to focus on the knowledge from the different countries, which I found very, very interesting, but still it's a European topic. So that would be very interesting if you please could give me some advice.
So, I mean, I would say two things. Thanks for that. I guess one lesson we learned from the financial crisis is that withdrawing policy support too early can be very costly. So all the forecasts I showed you before, which show a relatively fast recovery in advanced economies, they all rely on fiscal and monetary policy support. So it will be very important to keep that until we see the end of the pandemic. Withdrawing it too early can, leave us short of where we should be, where we expect it to be pre-pandemic, and that can lead to scarring effects on the labor market that will be very costly and will slow down growth going forward. So that would be for me, number one. But getting more to the trade question, the pandemic is not just a EU bloc problem, it's a global problem, and it's incredibly important that we understand the spillovers, and it's not going to be over for Europe or anyone if it continues to be a problem in developing and emerging economies. So it's fundamental that we take a cooperative or broad view, taking into account the spillovers, and factor it in when deciding on the next moves with the vaccine. We need to make sure that the pandemic is dealt with properly in the whole world, and that will prevent the mutation into new strains, the spillbacks from one way or other. We cannot keep borders closed forever. So it's very important that the situation is considered with a very global open view. So those would be my, main two things. That yes, focus on the emergency, which is Europe, but it's fundamental that we look at what's happening in the rest of the world, and reinforcing programs like COVAX to get the vaccine through to the developing world is fundamental, I think, even if you take the very selfish perspective of an advanced economy.
So Silvana, that is actually an answer to a question that appeared in the Q&A here about how even if we take a selfish perspective, it's very important for the rest of the world to recover well. I mean, and another thing that I think is highly relevant, and I guess it's also in part a question to Karin. I mean, it's a somewhat politics question, which is you're representing in some ways the UK. The UK Brexited, and here we are. Now in some ways, trade economists would have expected trade interruptions. Maybe been some. We have some sort of trade agreement and we're going forward. But now I would also argue that it seems to me quite possible that in the UK, you say, well, we did quite well here. We did well on vaccines, better than EU. So after the fact, maybe some people were very worried. Okay, we Brexited. What did we do? But now, maybe now it's the Brexit is back in the sense that it looks at least superficially like the UK did quite well in the second phase, at least. So what are your thoughts on the UK perspective on that? And maybe Karin, what do people think in Brussels? Like how do you view Brexit now? And there's also a question going forward. Okay, but now maybe now going forward, it's going to be a drag on the UK again. Well, they acted fast on vaccines, but yeah. So I think this is it's an interesting mix of issues that are very UK specific. So it would be interesting to.
Yeah, so that's a great question, Per. And I really don't know how this will be all processed in the end. It's true that the vaccination rollout has been slower in the EU when compared to the UK, as well as the US and Israel. But compared to most countries that play solo, the EU is ahead or at par. Compared to Canada, they are at the same level of vaccination and well above Australia, Japan, New Zealand. So my sense is that we can't draw strong conclusions from this one single observation in which perhaps getting out of the bloc led to an advantage, because if the comparison is other countries that play solo, perhaps being the bloc was an advantage. So what helped the UK on this? Do they have better skills at negotiating the terms, or did they have it in this opportunity with the vaccines? We don't know the answer to that. It's one data point. It's an important one because it was obviously a pressing crisis. So I think certainly it's taken as a favorable view of Brexit at the moment, but of course the match is not over, and the pandemic will not be over just because the UK manages to vaccinate the whole population. It will depend on the global outlook and so on and so forth. So I think, it's a bit too early to conclude, and also this is just one aspect of the Brexit much bigger package, and I don't know how that will play out going forward. So again, it's hard to predict, how people put together the different elements and their health outcomes, economic outcomes, how they attribute them to the fact that the UK was playing solo versus none. But this is fascinating certainly for political economists, which will be looking at this. My sense is that it's still too early to say whether it was an advantage. It might be that if the UK was in the EU, the negotiation would have been different. They would have accelerated the process. But this is in some, given that there was to some extent, this fixed supply of the vaccine, it's not that the gains from one country are really, a reason for celebration, because that detracts from other countries. So it's a very complex problem, I would say.
I agree, and I like the fact that as a researcher you point out this is one observation and you cannot draw a lot of conclusions from. Well, what's your view, Karin, on this?
Well, I think I will not surprise you when I say that I don't think Brexit is an answer to anything. As a very EU-friendly liberal, it's not the answer. And of course, we have to, we're in the middle of the crisis right now, and later on we will have more facts and studies and how we dealt with the situation as a whole. But I think it's dangerous to use the British example as a role model how to provide vaccines to the population. We all know that there is old agreements between Oxford University and Astra that ask the industry to provide the British population before exports. Imagine if all EU countries have had similar agreements, or if all other EU countries have, if they have acted solo, what have been the result? I'm quite sure to say that I think that we have been stronger together, and the greatest and most dangerous challenge for vaccine production and distribution today is different kinds of protectionism. And I think we have really to see on the other side of the Atlantic, where the US is not the role model in this case. The US has different kind of protectionist measures on the vaccine itself, on components which you have to use to make vaccine, but also for equipment to produce vaccines. So as a Swedish liberal, I'm very much believing to keep up basic principle for free trade to produce and distribute vaccines, and maybe if you find the British example good, I think it's despite of Brexit.
Okay, that was clear. We're running out of time, but I don't know if you want to weigh in on something, Rikard, at this point. You should.
Well,
you should if you.
Yeah, no, two things. One comment on the crisis is that one thing I think we learned from the previous financial crisis was that these global value chains, they're much more robust than we thought. So trade economists, they thought that once these links are broken, it will take years to repair them, but they came back very quickly. And I think we see the same now. So that's a little bit of a positive note. I think that once we get out of the pandemic, we get back on track quite fast, actually. And then on vaccines, I agree that the open borders are important, but I think also we could perhaps say that governments should have poured more money on vaccine production. We were too stingy. The global supply is too little. We should have invested in more production facilities, but that's easy to say now, of course.
Yeah, but I think it's also important to think about going forward, because this may not be the last pandemic, as much as we'd like it to be. Can I turn back to something which actually Karin brought up, Silvana? I know this is probably a tough question for you in your position to answer because of the nature of the question, but can you say something about the relative importance of monetary versus fiscal policy? Let's say that you don't have to comment on your own. You've of course done a great job. It's a one observation, but anyway. But what do you think in this type of recession? So not recession in general, but do you think that we would have been, worse off with both types of interventions? Which one has been more critical, or which type of policy has been more critical within these also? Because I think that's something very important to think about.
I think, I mean, definitely from the perspective of the UK, fiscal policy has been the main player in this pandemic, you know, targeting the areas that needed direct support and assistance. And in the UK in particular, the furloughing system, the replacement of wages or wages being paid by the government has been fundamental to keep the job matches and trying to sustain that structure so that after the crisis, when people could return to their jobs and without much losses in much loss in human capital and in much formation. So that the fiscal policy has definitely played the main role. Monetary policy has played a supportive role. Definitely it intervened massively and timely when there was financial disruption. So back in March with the dash for cash, monetary policy around the world, not just in the UK, intervened very, very swiftly. And that prevented perhaps an escalation in, you know, that could have reverberated or you know, had its consequences through the financial system. So I think that was very timely. In general, monetary policy, as I said, played the supportive role. It helped bolstering firms and households' cash flows, preventing unnecessary defaults and business failures by keeping the cost of borrowing low. So that was helpful, and it also stimulated demand in the sectors where it was still possible to, or the sectors that remained open. So it supported both businesses that were closed by keeping their costs low and open business, which could see an expansion in demand. So it facilitated that substitution during the crisis.
So I see also in your graphs, you indicate especially the UK and the US are bouncing back quite strongly, especially during the most recent revision indicated that, I think, if I read your graph correctly. I mean, is it also the case, do you think, that this could be due in part because vaccination has worked quite swiftly in both places, but is it also, do you think, related to how labor markets work differently in different countries? I mean, there's a bit of history we have on how European labor markets are a little bit different, or do you think it's policy is the most important reason for these differences?
So the reason why we see this much faster recovery in the US and the UK as in Israel, certainly vaccination is playing a big role. In terms of policy, I mean, what is interesting is that the UK this time around played much more the European way, supporting job matches, whereas the US, and that's why unemployment, you know, if you see the unemployment figures, they didn't go up. So it was much more the European way. The US played a very completely different, its usual way. So the support was through sending checks, so that supported demand. It is interesting that the fall in the US was much less, about half of the big fall that the UK saw. It was certainly less dramatic. Households' incomes in the US actually increased, which is again very unusual for us business cycle.
Yeah, remarkable figures.
And so
Silvana,
yeah.
Sorry to interrupt. I think it's my fault because I asked the question very, very late. It's now 4 o'clock. We have to end this interesting discussion, and so I would like to thank you, thank Karin, thank Rikard, and thank the people who have participated passively and somewhat actively in the background. It's been super interesting, and thanks again for coming and for doing all this for us, for the SNS and for the IIES as well. Thank you very much.
Thank you.